What is price action? We have 13 questions on price action, and the objective is to ask Al some different questions, different to those that he normally gets on his other podcasts and on his website. They've been broken down into 4 files for ease of listening, so the next 4 lectures contain Al Brooks talking about price action. Question 1. Okay, Al, let's start at the beginning. What exactly is price action? Can you explain what price action is to someone who is just starting out as a trader? And why should a wannabe trader be interested in price action at all?
When most traders talk about price action, they simply talk about the movement of price on a chart, a 2-dimensional chart, usually with the time on the bottom, horizontal axis, and price on the vertical axis. For me, every time a chart moves up even 1 tick or down 1 tick, that represents price action. The market is moving, movement is action. I'm interested in what the market has been doing over the past many bars. For example, if you're looking at a candlestick chart. The presumption for all traders is that markets are not random. They move because of some underlying force. Traders like to trade on the basis of momentum, betting that the market will continue to do what it has been doing. For example, if it's been going up relentlessly, it's probably going to go up at least a little bit higher, and therefore traders will look to buy. However, if it reaches some extreme point, like some resistance point, there are many ways to determine resistance, traders instead will wait to buy a pullback. Aggressive traders will bet that the bull breakout will fail and reverse. The most recent bars on a chart are more important. For example, the past 10 or 20 bars are more important than bars from 100 bars ago. Why would someone starting out be interested in price action? Because just about every profitable trader uses price action to some extent when they trade. It doesn't matter if they're a hedge fund or a firm trading based on fundamentals, they're looking at charts. And as soon as they look at a chart, they're looking at price action. They're looking at support and resistance. They're looking how the market is responding when it gets to support below or resistance above. They want to see if the market will break through or reverse. They want to buy at support. They want to sell at resistance. If a fundamental firm, a firm trades based on fundamentals, believes the fundamentals are good, yet they look at a chart and the chart is at the top of a bull channel, they'll probably wait to buy, or they'll probably only buy a small position. On the other hand, if the market is selling off and it's now at a bull trend line and that firm believes the fundamentals are good, they'll become very interested in buying. Therefore, I believe almost everyone who trades profitably looks at price action. Even if you're a high-frequency trading firm, you're making your decisions based upon what the market has been doing over some recent time interval. In other words, you're looking at the action of the market. You're looking at price action.
Question 2. Can a trader make a living trading off only the 4 best trade setups we have here? If yes, how should they go about learning and applying these setups?
I remember about 25 years ago, one of my friends was trading online with me, and he relied on a single pattern to trade. He was trading 1-minute charts and looking for tick divergences on the 1-minute chart. He was trading about 25 contracts, trying to make about 1 to 2 points a day in the E-mini. I was fascinated by that because I see so many things on a chart. I just wondered why he stuck to only one thing. Yet he stuck to it because he was comfortable trading it, and he was in his comfort zone. That's important as a trader. You have to do things that make you comfortable. So he was profitable trading simply a single pattern. Now, I talk about many different patterns. I talk about breakouts and channels and trading ranges and major reversals. I think a trader could make money trading any one of those patterns. I also think that a person can build a house with only a hammer. However, he would build it much faster if he had a hammer, a saw, and many other tools as well. And that's true with trading. If you have many different tools from which to choose, you have more opportunities to make money. However, starting out, I think traders should stick with a single setup, one that they feel like they're reasonably comfortable trading. I've received lots of emails over the years from traders who have settled on a single type of trade. For example, I recently received an email from a fellow who trades reversals. He looks for strong sell-offs or strong rallies on the open, and then he fades them. He bets against them, looking for a small profit. I have other traders who only trade major trend reversals. I have other traders who like trading ranges, looking for second reversals. If the market's at the bottom of the range and reverses up, he does not buy. He waits for the bear trend to resume down and then looks for it to reverse up again a second time, and then he buys that. Any of these techniques can result in a person having a very profitable career. But as I said, the more tools you have, the more trading opportunities that you'll see on the chart. When you start out, everybody starts out with one or two patterns, and that's okay. Trade them until you get good, until you get consistently profitable, and then start trying to add other setups as well.
Question 3. As you will often say, Al, interpreting price action within the market context is very important. If context is all the bars to the left, just how far back to the left are we talking about? How does a trader know when or where to stop looking to the left? And does whatever you say on this apply equally to all markets, including the ESE mini and Forex markets, and all time frames?
When I talk about context, I talk about the bars to the left. The more recent bars are more important than the bars from long ago. For example, if you're looking at a chart, the bars 20, 30 bars back are far more important than the bars 500 or 1,000 bars back. However, the bars from 1,000 bars back could be very important if you're looking at a higher time frame chart. For example, if you're trading the 5-minute chart, you're not going to be looking at bars 2,000 bars back, 5,000, 10,000 bars back. However, you'll occasionally look at the monthly chart and you'll see the market has some support and resistance on the monthly chart. And often the market will make a big move at some monthly support and resistance. I remember I was in a trading group with very good traders about 8 or 10 years ago. I guess it was 2009. The market was selling off strongly. On the 5-minute chart, there was a pattern. There was a wedge bottom on the 5-minute chart with a good buy signal bar. I told the traders in the group that I thought this could be the low for the next 5, 10, or 20 years. You wouldn't believe how they scoffed at me at the time. However, I pointed out a monthly chart, and the market was reversing up from just below a monthly trend line. There was also a 1-bar final flag on the monthly chart. Therefore, I expected the market to reverse, and I was looking for a pattern on the 5-minute chart. On the 5-minute chart, a trend line that goes back 10 or 20 years is thousands and thousands of bars back. Yet, those bars are significant. Nobody's going to look at those bars on a 5-minute chart, but they will look at them on a monthly chart. Therefore, if I'm looking at a 5-minute chart and I'm interested in bars from 100 bars ago or 200 bars ago, I'll look at a higher time frame chart, like a 60-minute chart, or a daily chart, or a weekly chart, or a monthly chart. Those charts are going to have far fewer signals. If a 5-minute chart has a reasonable signal based upon the past 20, 30, or 40 bars, a daily chart, a monthly chart, will probably also have reasonable signals every 30 or 40 bars. However, 40 bars on a monthly chart is several years. If I'm trading the 5-minute chart, I'm going to be much more interested in the patterns on the 5-minute chart because I'm going to see lots of patterns every day. However, I sometimes do also pay attention to the monthly chart, the weekly chart, the daily chart, which have patterns that extend back thousands and thousands of bars on the 5-minute chart. Again, the further you go back, the less frequent you'll get patterns that are tradable on the 5-minute chart. I'm much more interested in patterns that develop today, the past 10 bars, the past 50 bars, the past 80 bars. Those patterns are much more reliable in terms of providing trades today. This is also true for any market, not just the E-mini. It's for stocks, for bonds, for Forex markets, and it's true on all time frames. Remember, I believe that price action trading is genetically based. People have been trading since the beginning of civilization. It doesn't matter what they were trading. And the traders who were really good ended up with more wealth, whether it's more food, more land, it doesn't matter. Good traders always made money. When you trade financial instruments, stocks, Forex, gold, crude oil, futures markets, stock index futures, it doesn't matter. Traders who trade better are going to make more money, and that's the goal for all of us. I think trading is genetically based. It's all logical. A lot of illogical things take place because not everyone is rational. But in a big market, a market that has a lot of participants, a lot of smart participants, like the Forex market, or stock index futures, or gold, or crude oil, bonds, those markets are going to be very logical, and it just takes a lot of time to understand what the logic is. Trading is genetically based. It's based upon rational human behavior, people trying to get the most that they possibly can from other people. And that behavior results in predictable, repeatable patterns on charts. You can chart that behavior. If you look at a chart of any market on any time frame, it's the result of rational human behavior, people trying to make the most that they possibly can make. Therefore, price action trading is always going to be a reliable way to trade.